You're listening to the Shaughnessy Group Podcast, insights on buying, selling, and growing Canadian businesses in the lower middle market. Let's begin.
Welcome back to the deep dive. You know, if you've ever looked at a company's profit and loss statement, it tells a story. But often, especially with private businesses, that story has a few critical chapters missing.
Or a few extra chapters that don't belong.
Exactly. So today, we are deep diving into that essential financial cleanup that has to happen before a company can even be valued.
And that cleanup it's everything.
Yeah.
What we're talking about is getting past the numbers on the page, which are historical and, frankly, full of an owner's quirks.
Right.
And figuring out what the business is actually worth to a new third-party buyer.
Yeah.
It's really the difference between a real offer and just a fantasy number.
Okay, so let's unpack this. This crucial step is called financial statement normalization.
Right.
And in simple terms, it's the process of adjusting a company's historical financials to show its true underlying economic performance. We're stripping away the accidents, the distractions, and, well, the owner's personal lifestyle choices.
And you have to do it. If you skip this, your valuation is basically built on sand. Our whole mission during normalization is to find a realistic, maintainable level of earnings.
Maintainable, that's a key word.
A huge one. It's the earnings that a fair, arm's-length financial buyer could reasonably expect to get from the business going forward. We need to define that expected earning power.
So the stakes are massive. If we don't normalize, we're going to get the company's risk and its profitability. Just completely wrong.
You will. Grossly wrong.
So why is it such a critical step? I mean, what's the ultimate impact on the final valuation number?
Well, it really boils down to two core concepts. They're totally inseparable. The first is establishing a basis of comparison.
Okay, tell me more about that. Comparison to who? To what?
We need to compare the company's financial health, its trends, its ratios, its profit margins, to other similar businesses in the same industry.
Right, it's peers.
Exactly.
Yeah.
But if one company is, say, running a ton of lavish personal expenses through its books, its reported expenses look inflated, right? And its margins look weaker than its competitors who've been normalized.
So normalization just levels the playing field.
It gives you that apples-to-apples baseline so you can truly evaluate its performance and its overall health.
That makes perfect sense. And I imagine the better that baseline looks compared to its peers, the lower the perceived risk is.
You've got it.
Yeah.
And that leads directly to the second reason, earnings stream determination.
Okay.
Once we have that clean, comparable number, that true earning power, we can confidently apply our valuation methods, whether we're using, discounting future cash flows, capitalization methods, or applying a market multiple. We need that reliable earnings number to start with.
I want to pause on those methods for a second, because for some listeners, terms like discounting or capitalizing might just sound like, accounting jargon.
Fair point.
Can you simplify what those are trying to achieve?
Absolutely. Think of it this way. Discounting and capitalizing are just two different mathematical ways of taking that future stream of expected earnings.
The one we just normalized.
The one we just normalized, yes.
Yeah.
And it translates that stream into a single number that represents today's value. But they need one input to work correctly, that clean expected earnings number.
Perfect. So if we establish a company is less risky because its normalized margins are excellent, that's reason one, then that lower risk lets us use a better valuation multiple reason, two, which gives us a higher final price.
Precisely. The perceived risk level directly dictates the capital rate or the discount rate or the valuation multiple you apply. If we leave all that clutter in the financials, the company just looks unnecessarily risky, and the valuation is either artificially deflated or, even worse, inflated for the wrong reasons.
So every adjustment is about one thing.
One simple thing. Remove items that are either unlikely to be repeated or are completely unrelated to the core business operations.
Okay, so let's get into those cleanup items. I understand analysts typically break these adjustments into three buckets. Let's start with the first two categories, the one-off events and the unrelated distractions.
Right. So the first bucket deals with unusual, non-recurring, or extraordinary items. And to qualify for removal, an item has a very, very high bar to clear.
Okay.
It must be both unusual in nature and infrequent in occurrence.
So it can't just be weird, it has to be rare. Like if I buy really strange office supplies every single quarter, that's not infrequent.
Correct. That's just part of your business model, apparently.
Yeah.
But if both criteria are met, we strip it out. We take it out because it doesn't represent the company's actual ongoing earning capability.
It's a classic example.
A catastrophic one-time event. Think a severe fire or a flood that just shuts down operations for a whole fiscal period.
Oh, I can see how that skews the picture drastically. If a natural disaster hits, revenues plummet, and then you have insurance deductibles and cleanup costs skyrocket.
Exactly. And if we just leave that quarterly report unadjusted, the company looks like it's just, falling off a cliff.
When really it was a one-time thing.
A one-time event that's not expected to happen again. Normalizing for it lets us see what the business would have earned otherwise.
So that handles the unpredictable accidents. What about the second bucket? The things that just fundamentally don't belong in the core business statement at all.
That's non-operating items. These are revenues or expenses that have absolutely nothing to do with the primary function of the business, no matter how often they happen.
Okay.
Think of a widget manufacturer. What's their job? Making widgets.
Right. So what if that widget manufacturer has a big cash surplus and decides to invest it in, say, a portfolio of municipal bonds? What happens to the income from those bonds?
That income is non-operating. It's being generated by having excess cash, not by making widgets. The person buying the business is buying the widget-making operation.
So the investment income gets stripped out.
It has to. It distorts the true earnings of the core business.
Now, if I'm the buyer, I might wonder, I want to see that non-operating income. Doesn't removing it make the company look a little less financially diverse?
That's a fair question, and here's the key nuance. We remove the income from the P&L to determine the core earning power.
Okay.
But the underlying asset, the actual securities, is usually still very valuable. So what the analyst does is value the core widget business based on its normalized earnings, and then they often value the non-operating asset, the bond portfolio, separately.
And then just add that value to the total price.
Exactly. You get credit for the asset, but it doesn't skew the valuation multiple that you're applying to the actual operations.
That clarifies it perfectly. Okay, now let's move to where I think the real fun starts, where that forensic lens is truly needed. Category 3.
Yes.
The bucket of discretionary items and owner perquisites.
This is the messy, highly specific area, especially in smaller, closely held businesses where the owner's personal finances can get deeply entangled with the company's books.
I can only imagine.
The goal here is simple, though. You remove the owner perks and you restate expenses to what they would cost if the company were run purely at fair market value.
And I imagine the biggest adjustment here has to be what the owner is actually paying themselves.
Absolutely. Owner compensation and perquisites is number one every time. In a private company, an owner can set their own salary based on tax planning or personal need or maximizing retirement savings, not necessarily what the job is actually worth.
So if the owner of a small regional service company is paying themselves, say, $1 million a year, but the fair market salary for a CEO of that size and scope is maybe $300,000.
We add that $700,000 difference right back to the company's earnings.
Wow.
We normalize the compensation to the fair market rate that a new third-party owner would expect to pay a professional manager to do that job. That $700,000, even though the current owner spent it, becomes profit for the new owner.
That is a massive adjustment. It could entirely change a valuation. What's next on the list of things that obscure the truth?
Related party transactions. This happens when the owner has two businesses, let's call them Company A and Company B, and they're constantly buying or selling stuff between them.
Okay.
And they might intentionally set the price way below the market rate. Maybe Company A is trying to minimize its taxable income, or maybe Company B is trying to look more profitable for a loan.
In other words, they're not transacting at arm's length.
Precisely. An arm's length price is what two independent parties, acting in their own self-interest, would agree upon. The analyst's job is to restate those transactions to that arm's length price to show the true economic reality.
Okay, and then there's the fun topic of company assets that are maybe not just used for the company.
That's personal use of assets.
Yeah.
The classic example is the company-owned vehicle.
Of course.
If the nice truck or SUV is mostly used for personal commuting or family trips, that asset and all its expenses like insurance, gas, maintenance, it needs to be adjusted. The analyst has to figure out who is using the asset and why, separating what's operationally necessary from the owner's personal convenience.
And finally, the wide, wild world of just straight-up personal expenses charged through the business. This must be where the real detective work comes in. Give us some of the highlights.
Oh, this basket is vast. We look for anything that is basically subsidizing the owner's life.
Right.
Common red flags are things like charging a personal home utility bill to the business as an office expense, paying a family member a salary for limited or, non-existent services that phantom employee cost.
I've heard of that one.
Oh, yeah. Or having these egregious travel budgets that are clearly covering personal vacations disguised as business trips. We also see home real estate taxes being charged as a business tax expense. All of these have to be found, quantified, and added back to the earnings.
So the owner might be reporting, say, $100,000 in profit.
Right.
But after you add back $300,000 in their salary overpayment and another $150,000 in personal perks, the true earning power is actually $550,000.
That's an entirely different business.
It changes everything.
It does. The analyst has to assume a new professional owner would immediately cut those perks, and that savings becomes pure profit for the buyer.
But this stuff isn't labeled personal perk on the income statement, right?
Not usually, no.
So how does an analyst even find these hidden expenses if the owner isn't volunteering the information? You mentioned needing a forensic lens.
That forensic lens is absolutely non-negotiable. It often starts with a very candid, detailed discussion with management. You have to ask direct, specific questions about general line items.
Like what?
Okay, what exactly is included in miscellaneous operating expenses? You'd be surprised what you find. But beyond those talks, you have to drill down into the documents.
So what does that deep dive into the documents actually look like?
It means going through the income statement line by line, comparing month-over-month expenses to spot anything that looks weird.
Any anomalies?
Exactly. And crucially, it involves tracking corporate credit card statement items and doing a detailed analysis of the general ledgers. You're looking for patterns, unusual vendor names, or just round number expenses that feel arbitrary.
So the deeper you look into the source documents, the harder it is for these things to stay hidden.
They can't hide. If the total travel budget seems way too high, you track the credit card statements. You see if those receipts were for commercial flights to Hawaii or for actual domestic sales calls.
You're digging for evidence.
You're digging for evidence that supports or refutes the stated business purpose of every single significant expense.
Okay, let's bring all this together. The main message here seems to be that normalization is just about stripping away distortion, whether it comes from a one-time accident or from the owner's purely personal choices.
That is the core insight. We remove the one-time items, we strip out the accounting anomalies, and we eliminate the order perquisites. And why? To establish a clean, predictable basis for the future earnings stream.
A stream a new buyer can actually rely on.
A stream they can confidently expect and use for their investment decision.
So it sounds like the key takeaway for any owner or buyer is this: the profit number on the P&L. That's just the historical starting photo. The true economic value is only found after all that essential financial photoshopping is done.
That's a great way to put it. And if you are buying, you need a team that knows how to use that forensic lens to make sure the valuation you're relying on is real. Expert guidance here is not a luxury. It's an absolute necessity.
Absolutely. We've been diving deep into financial statement analysis, and it raises a fascinating final thought for you to consider. If a company's true value relies so heavily on normalizing away all the personal perks and the owner's salaries and the related party dealings, what does that imply about the inherent complexity and, frankly, the opaqueness of running a closely held business? That's something to mull over.
It certainly is. And, we really want to thank the organization that provided this comprehensive insight into the normalization process.
We do.
These expert insights come from the Shaughnessy Group.
The Shaughnessy Group was established back in 2017 to help business owners sell or divest their privately held, lower middle market businesses. They also help clients grow through acquisitions and secured debt funding. They are truly experts in understanding what makes a private business tick.
To learn more about their guidance and find more resources on M&A strategy and valuation, you can visit their website at shaughnessy.group.
That's SHAUGHNESSY.group.
That's the one.
Thanks for joining us for another deep dive. We'll catch you next time.
Take care.
This podcast is for informational purposes only and is not professional advice. Consult qualified advisors for your specific situation.